Hello, and thank you all for joining. For today's webinar, we are going to be reviewing efficient investing through probably the most utilized investment methodology, which is efficient investing based off of modern portfolio theory. And for those that do not know me, my name is Luke Yango, and I am a financial planner within Continuum Consulting Group. Now, as always, a quick disclosure from our compliance department, and I do want to mention any tax-related items usually are best reviewed with a CPA to ensure that they're applicable to your personalized situation. But let me first give you guys an overview of our firm for those that are not clients on the line or just do not know us. And we are a boutique wealth management and financial planning firm here in beautiful Irvine, California. However, we have clients across the majority of the states. And what we do with our clients is we work with them on their holistic financial planning and investment management needs. I personally found that the financial services industry is really just too focused on the investment side of planning. So we make it a priority to take a comprehensive and holistic approach to planning and to continuously educate and to help proactively plan for whatever life may throw our clients' ways. Our financial planning process does involve building a well-designed financial plan and then organizing our clients' investments in coordination with that plan, and then just ensuring that any outside planning items have been handled, which may or may not involve our collaboration with other professionals. And here's a quick overview of our team. Within the firm, we have 7 planners, myself included, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. We take pride in the work we do. We love working with our wonderful clients. So for the clients on the call today, thank you as always for placing your trust in us. But enough about us. Let's get into today's topic. And for today's conversation, we're going to be sticking to the first layer of the planning pyramid, which is money management. And we'll be spending the majority of our time focused on 2 key areas, which are asset allocation and security selection. And I want to tee this conversation up by saying we aren't going to be talking about the next hot stock to buy or how to time the market. What we'll be doing is we'll be spending our time discussing investment strategies and disciplined approaches to working towards long-term financial health and long-term financial freedom. So for today's agenda, we'll first start by reviewing some of the basics that we all need to be aware of before getting into some of the more details surrounding today's conversation. So we'll review asset classes and explain some of the varied investment options that we all have available within our portfolios. Next, we'll review the efficient frontier methodology. With that, we'll discuss risk and return and explain how their relation works and how risk and return works within the efficient frontier strategy. Then we'll get into security selection. And lastly, I'll close by debunking some of the common myths associated with investing that I see all the time as a financial planner. So let's start off with an asset class review. Now, this may seem a little elementary to some, but it's worth reviewing as others may not have the proper background to understand kind of the bulk of today's conversation. So first, understand that an asset class isn't necessarily a type of investment. It's just how we categorize all the varied investment options available to us as investors. And from a broad level, there are a few main asset classes that people are typically aware of. First, cash. Then there is equities, which is the direct investment into some company. And generally speaking, equities are one of the more volatile investment options. But if you're looking for a historically safer investment option than equities, many people turn to bonds, both government or investment grade. Alternative investments are more of a style of investing rather than a typical asset class like cash, equities, or bonds. And without getting into too much detail now, a few points to note about alternatives is that many times they have a lot less correlation compared to other asset classes, which is very important when diversifying a portfolio. But typically, these types of asset classes, alternatives, are a little more complex and can be illiquid. Now, high yield and emerging market bonds are another version of bonds, generally a little more volatile than potentially a government bond. And then lastly, from a core asset class level, we have real estate, which is exactly what it sounds like. investment in real estate holdings. And I could go on and on and on about these asset classes, and I could go into the ins and the outs of them. However, for today's conversation, you do not need to know all the granular details. All you really need to know is that there are investments, for example, Apple stock, and these investments, they fit within an asset class. Simple as that. But one more thing to know is that these asset classes here are about as general as you can get. And there are a lot more on a deeper level, kind of shown by the smaller pie chart within the larger pie chart. For example, within equities, there are US-based equities, both large, mid, and small cap, international equities, emerging markets, and more. There are numerous types of bonds, varied alternatives, and so on and so forth. And with all this variability in asset classes, you also see different asset classes that yield different returns, both yearly and historically. For example, this is an illustration of returns of varied asset classes in 2008 in order of top performing to lowest performing. Now, taking a look at this chart, you'll see that the international markets equity, were down about 44% for the year, and the U.S. stock market was down about 39% for the year. Now, this type of year may concern any potential investor because of potential loss of capital. However, let's take a look at the following year. International was now up 32% and US equity was up 37%. But to show you even more variability, take a look at 2010 and beyond. There is absolutely no consistency to this graph. These asset class returns vary drastically year to year, and it simply shows that return consistency is not a thing when it comes to investing, and varied asset classes will move with the markets differently. But why am I explaining this to you? Well, it's because you have to understand this before you understand efficient investing, which is what I want to talk about now. And the methodology we're going to talk about begins with risk and return. Essentially, there is no free lunch in life. And if you ever want return in any capacity, you do have to take some level of risk. Whether that risk be the risk involved with holding cash, which is defined as the least risky of asset classes, but some would debate that, or the risk of holding international emerging markets equity, which is one of the highest risk asset classes, but has shown to produce some of the largest long-term rates of return, to all the asset classes in between shown here just for illustration purposes. To receive a return, you have to take on some risk. And if you don't want any risk, then you really can't invest. But the age-old question to investing is, how do you get the highest rate of return for the lowest amount of risk possible? And that is exactly what the Efficient Frontier methodology has helped to calculate and to solve. And basically what it says is that for whatever risk you are, whether you're a low-risk investor who just isn't comfortable with regular volatility, to a high-risk investor whose sole goal it is to get the most return from their dollar, generally speaking, there is a mix of the asset classes that will help you efficiently position your portfolio for your desired risk tolerance. And how I like to describe it really is like a recipe for investing. Just like when you're baking a cake, you follow certain instructions. The same concept applies to investing. You don't necessarily just put 1 cup of sugar, 1 cup flour, 1 cup salt, and some milk into a bowl to bake a cake. That probably tastes horrible. You'd probably do, a cup of flour, a half cup of sugar, a pinch of salt, and then some milk, whatever the recipe calls for. The same goes for investing. If you want to be a mid-risk investor, you're not just going to put all of your money into mid-risk investment asset classes like US large cap value stock or certain type of bonds. Sure, you might have a good portion of your portfolio in those positions, but you also might have some international equities, emerging markets equities, government bonds, maybe some cash. And what that's going to do is help to reduce the overall risk in your portfolio. And this concept, it's not rocket science. It just goes back to that first chart that I showed you. Different asset classes move differently with the market. Simple as that. And when you have a diversified portfolio of good investments spread across the varied asset classes, Your portfolio should have less volatility, but will still target that attractive long-term rate of return that your financial plan may be calling for, so long as you organize your investments in the appropriate manner. So to explain this concept in an extremely simplified example, let me show you another diagram. And I want to preface it by saying this is not exactly how financial investments work. It's really just for illustrative purposes, but it helps to prove my point. And let's just say the chart on the left is your two-stock portfolio, and the blue line is Apple stock. Well, Apple is going to have some fluctuation, but hopefully in the long run, it's going to grow and you're going to see a return, which can be seen by the line going up over time. Well, let's say the second stock that you had is Microsoft. Generally speaking, obviously I'm speaking in generalities because this isn't how it works every single day, but these two stocks are fairly correlated because they're both in the same country, they're both in the same industry, and they do offer a lot of the same products. So when consumer demand goes down for laptops and phones, both companies may take a hit to their stock price. So for illustration purposes, Microsoft stock may look something very similar to Apple's, as you can see kind of in the line below Apple. And even though you have a two-stock portfolio, you essentially don't really have that much diversification because these two assets are extremely correlated, at least in this example. So your collective portfolio would look something like the line in the middle, that dotted line. Essentially, you have no diversification because the two positions are extremely correlated. Now, let's just say for illustration purposes, your friend on the right also has a two investment portfolio. And the stock he owns is Apple, now the blue line on the right. Well, Apple will look the same as it did in your portfolio. It's going to perform the same. But let's just say instead of owning Microsoft, a fairly correlated asset, he decides to invest in a real estate mutual fund. And if you remember anything from that colorful chart I showed you a few slides back, real estate is a very uncorrelated asset to other investment options. Well, in this scenario then, his real estate-based investment may look something like the orange line on the right. And when you put these two asset class returns together, your portfolio would look something more or less like the green line in the middle on the right. And what that is a much smoother line, a much smoother rate of return with less volatility. And obviously, you would not want a two-stock portfolio, and your return is never going to be a straight line from A to B. However, the idea behind it is what I wanted to explain. When investing in like investments, you generally receive like returns, both positive or negative. And you're going to be exposed to more of the ups and the downs like in the first graph. And that ultimately increases your overall risk, which is just a measure of volatility. So let's go back to the efficient frontier chart then. And if you analyze your portfolio and find out that it isn't necessarily efficient, for example, like this hypothetical portfolio shown by the red dot, then you have options to improve your portfolio and make it efficient through proper diversification. And to do this, you could either decrease your risk while maintaining your projected rate of return, and that's how you would arrive to that blue dot. Excuse me. Or you could maintain your risk if you're comfortable with it and actually increase your projected long-term rate of return, arriving at the green dot. So at the end of the day, if you're missing asset classes, or if you have too much concentration into one type of asset or one stock or bond, well, then a lot of times you have the options to broaden your investment reach, improve the diversity of your portfolio, and ultimately create a more sophisticated portfolio. Now, I hope that makes sense. If you have questions, please stay tuned to the end because I will be opening it up then. So what I want to talk about now is a little more detail to investing. What I touched on really is just a piece of the strategy, which is understanding diversification. The second step is actually implementing it. So let's review that now. And first and foremost, you need to determine kind of the risk level that you're comfortable being at. That's the first step to this equation. And once that has been established, then you can determine your, let's call it your recipe for your risk tolerance, as I mentioned a few slides back. And shown here is just one example. You'll see on the left the broad asset class selection, which gives you a breakdown of the general asset classes, and on the right, a more granular breakdown. For example, on the left, you see that equities do play a large role in this investor's portfolio. This investor is on the riskier side of the spectrum, meaning they're okay with volatility. And because of that, they invest fairly heavily into equities and alternatives. However, when you look at the more detailed asset allocation, on the right side, this individual or these individuals' asset classes are now fairly balanced between the various equities and alternative components. But what is also important to note is that within the more detailed asset allocation section, there are even more layers to it. It is like an onion. For example, high level, you have equity, ownership of stock. But as I just showed you in the previous slide, there is more to it. From an investor's perspective, you can have equity of the international markets, the US markets. So let's just stick with US equity. And then within the US equity, you can dissect it even more. In that you could have large cap, mid cap, or small cap equity. So let's stick with the most common, which most people know of, which is large cap equity. And then finally, you can have dozens of options to choose from within the large cap equity sector, including healthcare, consumer goods, tech, energy, and much more. And just like it's important not to be invested in just one holistic asset class, for example, just US stock, it's also important not to be invested in just one granular asset class. For example, just invested in US tech stocks. And this is important to understand when reviewing your portfolio because sometimes misbalanced portfolios just happen by accident. After years of purchasing stocks or reinvesting your money into various funds or however you manage your account, sometimes your portfolio alignment just becomes something that you didn't necessarily expect it to be. And if this is the case, then the next step would be to then go out and rebalance your portfolio, which is essentially reallocating it to be positioned to a strategy that you desire. And here are the steps to do so. First, you'll want to identify your current mix of assets within your portfolio, and you'll be able to see this after completing an entire analysis of your overall investment picture. Second, you'll want to identify opportunities to sell out of certain securities in a tax-efficient manner to raise cash. Keep in mind, though, that if you're going to rebalance, it is much easier to do so in a retirement account because liquidating positions in a retirement account and then reinvesting them, so long as the money stays in the account, is a tax-neutral event. However, if you're selling securities in a taxable investment account, like a brokerage account or a trust-based investment account, usually any gains are going to be subject to the capital gains tax, which we'll discuss here shortly. Now, the third step is that you'll want to identify new investments that fill the gaps of your current investment strategy. And to assure that you have properly diversified this, you'll want to really do a full analysis of your portfolio, like I said, and spend the time to determine what gaps you may or may not have. And then lastly, you're obviously going to want to execute the trades and then finalize your strategy. And generally speaking, we do this for our clients, and I recommend this for those that manage their own accounts, but you typically want to review and potentially rebalance on a quarterly basis. Now, this is just a rule of thumb, more or less to review your portfolio on a quarterly basis and just kind of check in, because once again, sometimes things are just missed. So you want to make it a regular action on your end to go in and do a quick review. And then additionally, the whole purpose of rebalancing is really just to balance risk and return, like we've been talking about this entire time. As you know, different asset classes move with the markets differently. So by rebalancing, you consistently maintain your portfolio's integrity. For example, when the markets are going up, generally speaking, the equity portion of your portfolio is going to grow quicker than the bond portion of your portfolio. Now, this causes your overall portfolio to now be a little more aggressive than desired. So rebalancing puts you back into equilibrium, and the same concept applies when the markets are trending downwards. When the markets are trending downwards, a lot of times equities perform worse than bonds, so you might have more bonds in your portfolio than equities. Of course, I am speaking in generalities here, but it just gives one example of why you should always be looking at your portfolio and considering rebalancing. Secondly, by rebalancing, it does enforce a level of discipline. It ensures that you stick to your investment strategy, and it helps to avoid trying to time the market or pick winners. You're sticking to an approach, you're sticking to a sound strategy, and that's generally what works for the long run. Third, it ensures that you're consistently reviewing your portfolio and keeps your assets and your retirement security top of mind. And then lastly, it helps you stay on track with your financial plan. So, in summary, rebalancing is key to maintaining the general structure of your portfolio. I hope this makes sense. But now, what I want to do is segue to the next section of efficient investing, which is tax efficient investing within non retirement accounts. And these accounts are unique because every year you're potentially exposed to taxes within them, even if you never sell any investments. For example, think about the broken up square to your left as a non-retirement investment account. And within that account, you have assets that are going to cause some taxation. Capital gains, mutual fund distributions, dividends, bond interest. This all increases your tax liability, which can be seen at your end of year 1099 statement. On the other hand, retirement investment accounts do not have these yearly taxes associated to them. You only pay taxes when you begin distributing from the retirement accounts, unless, of course, they're Roth accounts and you're taking a qualified distribution, which essentially is a distribution after age 59 and a half, and you've had that account for over 5 years. So how does this relate to our conversation today then? Well, if you're trying to be efficient within your investing, then you have to manage your accounts for tax as well. And it goes beyond just diversification. Because as I always say, it's not about how much money you make through investing, but it's also about how much money you keep through tax savings. So when it comes to retirement accounts, you really don't need to worry too much about what you're putting into the accounts. Because like I mentioned, you're not going to be exposed to taxes until you distribute. But if you have non-retirement investment accounts, generally it may be ideal to use state-specific municipal bonds because the interest that you receive from the bonds generally will not be subject to taxation. Long-term assets that you plan to hold for many, many, many years are great within taxable accounts because you can postpone the capital gains tax. And lastly, if you're investing in mutual funds, you'll typically want to avoid actively managed mutual funds and you'll want to stick with index-based funds. Now, if you want to invest in non-state specific bonds, if you want to invest in some short-term assets or some actively managed funds, well, those may be best positioned within your retirement accounts. But these, of course, are just rules of thumb. And like I mentioned, everyone's situation is different, but being aware of these strategies is the first step to proper asset management and proper asset placement. And I know I've been giving you a lot of information today, and I'm sure some people have some questions, but just know that we are always here if you want to review, and we will be opening up to questions at the end. But to end today's conversation, I do want to close by debunking some of the many myths that I hear in relation to investment management, because as a financial planner, I've really heard them all. And after reviewing these 4 myths, we're going to close out. And then, like I said, I'm going to open it up to some questions because I'm sure everyone has something top of mind that they want to discuss. So let's start off with the first myth. I hear this a lot, and it means that more investments means a better portfolio. And this is just flat out false because diversification doesn't necessarily have to do with how many individual positions are in your portfolio. It has to do with the quality of those positions and the asset classes they're categorized into. And as just for an example, a single mutual fund may have hundreds of investments within that one fund. Even though you just see one fund within your portfolio, it could have hundreds of bonds, hundreds of stocks, or a combination of both. And an individual investing in this fund may be significantly more diversified than an investor that holds 200 stocks if all those stocks are just US large cap energy stocks, for example. And sometimes I even see that the more investments that someone has in their portfolio can actually create more issues, such as difficulty in managing your portfolio allocation or potentially just additional trading costs. So in summary, more investments or more positions doesn't necessarily yield a better performing portfolio. It's the quality of those investments. Now for myth number 2, individual stocks perform better than funds. This is just wrong because in many cases, funds are just groups of stocks. And they typically follow a singular strategy. For example, investing directly in the US economy or trying to attract some sort of index. And the main difference between stocks and funds are that with stocks, you directly own the shares of those publicly traded companies. And with funds, you own a portion of a portfolio that directly invests in a basket of investments, which is usually managed by a fund manager. And generally, there are some great benefits to investing in funds, which that's typically very easy and very cheap way, or it's a very cheap way to invest in a broad range of investments, which you may not have had the ability to invest in otherwise. For example, you may not have enough money to buy every single stock in the S&P 500 index. However, you could buy a mutual fund that invests into those stocks for you. So on to myth number 3, which is a diversified portfolio is a conservative portfolio. And generally speaking, a diversified portfolio often yields less volatility. It doesn't necessarily mean it's going to yield less return. So to prove this to you, look at the historical returns of many of the asset classes we've discussed. And from 1985 to 2020, emerging markets had a return of 12.2%. Domestic equity returned 9.6%. Small cap and mid cap equity 9.1%. Real estate 8.5%. International equity 7.6%. Excuse me. And bonds have returned around 4.1 to 5.5%. And I show you this not to excite you to go put all your money in emerging markets and US stock, but to explain that generally speaking, most of these asset classes perform pretty freaking well in the long run. And when diversified, all you're really doing is lowering the volatility that comes with just investing in one asset class and ultimately lowering a lot of the short-term volatility, not necessarily lowering your long-term rate of return. And I think after today's conversation, most of you would understand that. So that leads me to the last myth, which is it's easy to time the market into stock pick. And this is a touchy subject for some. So rather than explaining my opinion, I'm just going to stick to the numbers. And between 1990 and 2011, active equity mutual fund investors, those that were trying to time the market, significantly lagged the general market. Or in other terms, they significantly lagged passive investors who just stayed invested in their portfolio during this time period. So during this period, inflation was 2.6%. The US economy on average returned 7.8%, but active investors only returned about 3.5%. But why is that then? Well, financial psychology explains it best. And what research has shown is that market downturns affect our mentality to investing 2 times as much as market upticks do. So from a psychological perspective, what was happening was people were selling their portfolio when they probably should have been buying or at least holding because they are being affected by market downturns, negative news. Think 9/11, the tech bubble, and the 2008 recession. Ultimately, what was happening was people were making what seemed like very little mistake, but they had very large long-term consequences, ultimately losing them money in the long haul. So what is the solution then? How do you avoid this? Well, to summarize everything we discussed today, it's a disciplined investment process and an investment policy statement that helps to keep you grounded to your strategy, ensuring that you're investing with a long-term mindset. And an investment policy statement it's just essentially a roadmap to investing. It lays out the general breakup of your asset classes that you're going to be invested into. It explains or shows you when you should be rebalancing, how you should invest in a tax-efficient manner, and so on. And at the end of the day, what an investment policy does, or policy statement does, is it really gives you a line of sight and it keeps you grounded. And hopefully it helps you avoid making some of those little mistakes that I mentioned that can have drastic consequences. And I'm sure today's conversation brought up a lot of questions. And like I said, I'll be opening up to questions shortly. But if you have questions, feel free to come talk to us. If you're a client on the line, just know that we're always available to talk. Our door is always open, whether you want to talk about your planning, your investments, or just catch up. We're here for you, so don't hesitate to reach out. And for those that aren't clients, my contact information is on the screen. You can always go to our website to reach us. Feel free to contact us. We are here to help and to provide guidance. And if you want to start the conversation regarding what it may look like working with an advisor like myself, feel free to reach out. But what I'm going to do now is open it up to questions. And for those watching the recording, I do have to close out before the Q&A. So if you're watching this as a pre-recorded webinar, just email me directly. But thanks again. I'll stop the recording now and open it up to questions.